Candlestick charts are an efficient way to look a lot of information about a stock price at once. It is clear that you can read dynamics of a stock's price, but how do you actually read a candlestick chart? In this video, you'll learn how to read candlestick charts and some other features that help investors better understand how the price is moving. Just quickly like the video and let's go for it. Hey there, Stockspert here. On this channel I share with my experience and educational videos about personal finance and investments. So make sure to check out also my other videos and subscribe to the channel for more videos in the future. And I invite you to make your first investment. Invest your click into the like button and I'll do my best to return your investments with very good insights. Interesting information from history. Candlestick charts were originated in Japan over 100 years before the West developed the bar and point and figure charts. In the 1700s, Japanese man named Hama discovered that while there was a link between price and supply and demand of the rice, the markets were strongly influenced by emotions of traders. Candlesticks show that emotion by visually representing the size of price moves with different colors. Traders use the candlesticks to make trading decisions based on regularly occurring patterns that help forecast the short-term direction of the price. So how do you read a candlestick chart? Each candlestick shows you 4 pieces of information: the open, the close, the high and the low price during a certain period of time. The body or thick part shows us the difference between open and close prices. If there is no body, it means that open price and close price were the same. The wicks or thin lines of the candlestick represent the high and the low prices in a given period of time. Here you can see an open price, which is a stock price at the beginning of the time frame of the candle, while the close price is the price of the last trade during the time frame of the candle. And respectively, high price is the highest price reached during the time frame of the candle, and the low price is the lowest price reached during the time frame of the candle. Time frames can be different, like 1 minute, 5 minutes, an hour, 4 hours, day, and etc. You may already know that there can be bear markets and bull markets. So as here, there is a bullish candlestick. A bullish candlestick is usually green, showing that the stock's price has increased. This means the close price is higher than the open price. While a bearish candlestick is usually red, showing that the stock's price has decreased. And this means that the close price were lower than the open price. And also there is a term called range. This is the price difference between the top and bottom of the thin line, shows how volatile price was in that time frame. Tall lines indicate that the price was very volatile, and short lines imply that the price was relatively stable, moving in one direction in a given time frame. In some cases, you can see additional bars below the candlesticks. This represents volume, which is the total number of shares which were traded during the time frame for that candlestick. Investors usually use this to understand the interest in a stock. Candlesticks are created by up and down movements in the price. While these price movements appear random sometimes, at other times they form patterns, which are used by traders for analysis and trading purposes. There are actually many candlestick patterns. I'll give some of them to get you started. Patterns are separated to bullish and bearish patterns. It is very logical to understand that the bullish patterns indicate that the price is likely to increase, while bearish patterns indicate that the price is likely to fall. No patterns work all the time, as candlestick patterns represent tendencies in price movement, not guarantees. So here's a bearish engulfing pattern. A bearish engulfing pattern develops in an uptrend when sellers outnumber buyers. This action is reflected by a long red real body engulfing a small green real body. The pattern indicates that sellers are back in control and that the price could continue to fall. An engulfing pattern on the bullish side of the market takes place when buyers outpace sellers. This is reflected in the chart by a long green real body engulfing a small red real body. With bulls having established some control, the price could head higher. As Japanese rice traders discovered centuries ago, investors' emotions surrounding the trading of an asset have a major impact on the asset's movement. Candlesticks help the traders to gauge the emotions surrounding the stock or other assets, helping them make better predictions about where that stock could be headed. And if you haven't started investing yet, here's eToro's social trading platform with the zero commissions for stocks and ETFs. You can check out full step-by-step guide on how to get started with it. I'll leave the sign up link in the description of the video, and I'll be happy if you register by that link. This is an affiliate link which will help this channel at no cost to you. And of course, make sure to subscribe the channel, like the video and hit the bell. See you in the next video.